Hey, everybody. Welcome to our newest episode of the Manufacturing Minute, where we aim to update you on trends and hot topics shaping the world of manufacturing. And we're really excited to be here with you today. As a reminder, I'm Megan Meador. I'm a audit and assurance partner here at Brown Edwards, and I lead our manufacturing and distribution practice. I will be the host of today's podcast, as always. And today we are excited to have as our guest an internal Brown Edwards person, a good friend of mine and a colleague, Vince Centofanti. He's a director here with us at Brown Edwards in our Valuation, Forensics, and Litigation Support department. Vince, welcome to the podcast. We're so excited to have you on today.
Yeah, thank you. I appreciate you inviting me. It's always fun to jump on and talk about something maybe a little different and outside the box of what some of your viewers are typically used to hearing about. So I'm glad to be here today.
Absolutely. Would you mind just to tell our listeners or our viewers a little bit about yourself?
Absolutely. Yeah. So I am actually from Charleston, West Virginia. So not too far away from you, but a little outside the state. And I grew up here. So I grew up in Charleston, West Virginia. I went to high school, graduate school, and college here in West Virginia. So I've never really ventured too far out. I've been with Brown Edwards and a number of other firms for about the last 11 years. It's funny, I actually started with a predecessor firm here in Charleston, and we merged in with Brown Edwards in 2018. And I was with the firm for about 6, almost 7 years before I had an opportunity to work for a national firm in valuation and forensic support for a couple years. And then I recently returned to Brown Edwards almost 2 years ago. So it's about 11-year career doing this type of work, valuation, litigation support, forensic work. So it's exciting. It's what keeps me up every day. I enjoy it.
Yeah, and we're happy to have you back with us at Brown Edwards for sure.
Absolutely. No, it's good to be back for sure.
So I know you and I have worked collectively, a handful of times now on business valuations. So let's just talk about what exactly is a business valuation and what does that look like?
No, it's a great question, honestly, because a lot of people don't even think that we do valuation work and business valuation work specifically. And so just to give a little bit of background about what we do is mostly it's in the realm of valuing either an entire business or a business interest in a private entity. So a lot of times a person will think about, well, I can just look at the stock exchange. And that's true for a company like Apple or Amazon or any other blue chip public company. You can go on your investment account and you can see live what the value of that company's stock is trading at any time in the day. But when you think of a small business, a private business, a family business, there is no market for that company and there is no readily available value for that company. And so that is really what we help our clients and what we help business owners do is understand what their interest in a private business is worth. And the reason that we do valuations is very broad. We do valuations for planning purposes. Like I said, maybe a business owner just wants to know what their business is worth. Sometimes it's for tax purposes, be that either gift tax, estate planning, estate tax filing after the passing of a business owner. We do valuations for income tax purposes, for financial reporting, mergers and acquisitions, all kinds of different purposes. I mean, it also gets into litigious situations. So think things like marital disputes, shareholder disputes, dissenting shareholder cases. So we do valuations for a very broad range of purposes, but at the end of the day, the goal of each of them is largely the same, and that's to establish some value for a private business or a business interest.
So sometimes people refer to valuations as appraisals, but those are vastly different, right? Can you help us understand the differences between the two?
Yeah, that's a good question. And so I think one of the things that you mean is the difference between a business valuation or appraisal and a real estate valuation or appraisal. And that's an extremely important consideration because in our world, the terms valuation and appraisal are largely synonymous. What's not synonymous is the difference between a real estate appraisal and a business appraisal. So a real estate appraisal is what most people are familiar with. You have to do one when you buy a house and you get a mortgage. The bank does an appraisal and they make sure that they're loaning you money that substantiates the value of the piece of property that you're buying. An evaluation for a business is It's very similar. I mean, the methods and the approaches that a real estate appraiser uses to value your home or any other piece of property is similar to what we do for evaluation. We have three major approaches that we consider when we value a business, just like a real estate appraiser would do when valuing a piece of property.
So do you want to briefly go into those three approaches that
Sure. Yeah, absolutely. And I'll kind of talk through a little bit about how we decide what makes the most sense for the type of business that we're valuing. And so the three approaches, broadly speaking, are what's called the income approach, the market approach, and the asset approach or cost approach. And again, there's methods that we utilize under each approach, and it would take us all day to get into every single method that we've ever used. But broadly speaking, the income approach is most applicable when valuing an operating company, some entity that is in business with the goal of generating ongoing annual profits and cash flow. And there's typically value that exists above the tangible assets that that business owns. And so, I know a lot of your clients, manufacturing, distribution, they do have significant assets, but they also exist to generate a profit. And so, even though they are asset intensive, the best approach in those circumstances is likely the income approach. Other cases, I mean, if you're talking about a professional services firm, a hospitality group, a restaurant, those types of things, again, you're talking about operating businesses that exist to generate a profit. And so the income approach is, in almost all circumstances, the most appropriate approach for valuing those types of businesses. The other side of the coin is the asset approach. And so that's something that we apply most typically in holding companies, be that investment holding companies, real estate companies, and even real estate operating companies. So think about a company that owns a significant amount of real estate and most, if not all of it, is rented out. That's a case where we may and oftentimes do apply both an income approach and an asset approach because they are heavily capitally invested, but they're also generating an annual profit on rents. And so that's where both of those approaches are likely most applicable. When you're looking at a holding company that maybe is holding those assets for appreciation over time, that's when the income approach is likely not applicable. So the value of that business is going to be in the value of its assets as of the date of valuation, not necessarily the cash flows that it's generating. It may not be generating any cash flows, if minimal at most. And so that's where the asset approach is going to be most appropriate. The last approach is what's called the market approach, and it's applicable in a lot of situations. And what it does is it attempts to compare the performance of the subject business, whichever business we're valuing, to some other business or group of businesses in the market. And so there's typically two ways that we apply it. One is either through comparison to similar public companies, which can be challenging because a lot of our businesses are smaller, much smaller than public companies. And another more applicable one is what's called a transaction method. So we have databases that publish this information, business brokers and others put this information out there. A lot of times we don't have the names of the companies, but we have information on companies that have sold or transacted in recent years. And so we will compare the pricing multiples of those recent transactions. So think deal price to revenue, deal price to EBITDA, deal price to cash flows, those types of things. And we'll come up with whatever those multiples are. And a lot of times in the merger and acquisition space, you hear things like 6 or 7x EBITDA. That's what they're talking about. They're talking about what that transaction multiple was of a previous transaction. And so let's say we have a reasonable group of transactions and we say that a good EBITDA multiple for this industry is X. We look at the EBITDA of our subject company and we multiply it by 7. And that is some indication that we can use to determine value for a business using market multiples that exist from actual live transactions that have taken place. So that's a lot. I mean, it may have sounded like Chinese, I'm not sure, but that we take all of that information and we synthesize it together to determine the value for the business.
Yeah, and I think what's important also is when you publish your business valuation report, that includes pages in the front of that it kind of explains your thought process, right? And the value method that you chose and that's decided upon to do the business valuation. So it is kind of transparent to a reader, the lens in which you're evaluating. You're
Yeah, that's absolutely right. And it's important that you mention the report. I mean, most times that we're doing these valuation engagements, we're putting together an 80 or 90 or sometimes more than 100-page report that really supports all the analysis and inputs that go into it and describe it in some cases in great detail. A lot of these reports are going to the IRS or to a court or to a potential buyer in a case when you're using it as a negotiating tool. And so you want to have the support. You want to have independent third party support for how this value is determined. That's another key consideration. We have to be independent of our clients and objective in our valuation. So there's no jumping over the line of whether we should skew the value in one direction. That goes against our professional standards. We have to be objective in our valuation analysis and independent of the client that we're working with to determine a fair value, a fair market value, not a value that appeals to a certain party.
And I think that the report that you also published says that as well, that we're
Absolutely.
independent and
Yeah,
we're
yeah.
using data obtained from management, right?
You're absolutely right.
So you just mentioned the IRS. So how do valuations come into play when you're either paying taxes or thinking about a future tax liability that you might have?
Sure. And I mean, it comes into play in a lot of circumstances. I'll touch on some of the main ones. And honestly, this is where we spend a large portion of our time is in estate planning. And so we do a lot of valuations for estate planning and for estate filing. And so I'll kind of go through the difference between those. When you look at an estate filing, that's when a business owner has already passed and they have some filing requirement associated with their estate. And so if that person passed with some interest in a business, let's say they and their two siblings own 33% each of their business. When they passed, their value of that business has to be reported on the estate tax filing on the 706. And it has to be reported at what the IRS defines as fair market value. And IRS in Revenue Ruling 5960 defines fair market value as the price at which that property would change hands between a willing buyer and a willing seller when neither is acting under any compulsion. And so that's important. We have to take into consideration a lot of hypotheticals here. We can't look at this specific owner or any specific buyer of this property. It has to be hypothetical, as if you and I were transacting this piece of property and neither was under. I'm not acting under any duress to sell it, and you're not under any motivations to buy it. So that's a key tenet of this fair market value standard that we apply in almost all of our valuations.
And I'm sure that's tough, especially when it goes to, into the realm of estate planning, because you're talking about a death, high emotions.
Sure.
Often, sometimes, we all think that what we have is very valuable, but sometimes, that's your job to do these business valuations and come up with an independent conclusion on what that's actually worth. And I'm sure that can be tough sometimes to
Yeah,
navigate.
it's interesting that you say that because I have had many times in my experience that sometimes a client will be upset with the value because it's too high. They want it to be lower so that their estate tax liability is
That's
less.
fair.
And
Yeah.
then there's situations where the client is upset that they think it's too low because they're
Mhm.
trying to sell it. And so they want the highest value. And so again, that's where that objectivity comes into play. We're not valuing a business to be lower for estate planning. We're not valuing it higher so that you get a better sales price. We are truly valuing it objectively to determine what this fair market value would be in an open market sale between willing buyers and willing sellers. And that's important. I mean, if we're not doing that, I mean, we lose our credibility, really.
Absolutely. So what are, outside of estate, what are some other important things that business owners should be thinking about or keep in mind if they're wanting to do a business valuation and are thinking about doing that in the upcoming months?
Yeah, I mean, the valuation process from an information gathering standpoint, that's a lot of times one of the more challenging things that we run into with some clients. A lot of times we'll work with clients who have audited financial statements. That's great. We typically start with that's like the gold standard. If we ask clients, send us your audited financial statements for the last 5 years, we may have some supporting requests on top of that, but that covers the majority of it. Where we run into issues sometimes is when clients maybe have never gone through an audit before or a review or a compilation. All they've ever done is they file their tax returns and they don't necessarily keep the cleanest books. So when we get into those situations, there sometimes is a lot of work on the front end to get the financial statements in a point that we can even start the valuation. And that can be challenging for both us and the client, honestly, because they maybe weren't expecting to have to do the level of cleanup that we need. We need to be starting with good, strong financial statements before we can even get into a valuation.
Do you require any kind of monthly analysis, Vince, to do that, or is annual information okay? Lots of our clients, for example, don't do gap true ups or any kind of real hard close, maybe on a quarterly
Right.
or even an annual basis. What does a business valuation require when it comes to that?
That's a great question. And again, the answer a lot of times is it depends. Typically, we will suggest to a client if we can do it as of a good cutoff date, either a year end or a quarter end when good financial information is available, we'll obviously recommend that. The challenge with that is for estate filing, you can't control when somebody dies. So if somebody dies on October 2nd, we have to do the valuation as of October 2nd. And so we have to find the closest financial statement that is closed. So October 2nd is a good example because it's right at the end of the third quarter. But if it was, let's say, September 1st or sometime in the middle of a quarter when maybe a good financial statement isn't available, we would have to get to that. The client and their accountant would have to work together to come up with an interim financial statement that is reasonable and accurate as close to the date of death as possible, because that's what the IRS requires. It has to be valued as of that date. And for example, if you're doing like estate planning and you're doing gifting, that's something that can be controlled. You and your estate planning attorney can control when that gift takes place. And our recommendation is always going to be to make that gift effective on the last day of the year or on a date that a good financial cutoff can be available, just because it makes the process smoother.
Yeah, and we're talking about obviously you can't plan for a death, but when you are planning for possibly a business sale or other
Sure.
kind of reason that you're doing a valuation, talk to us a little bit about how long that takes. Like, how long does your process take from start to finish? And I know you're going to tell me it depends
Yeah.
because it's going to depend on the data that's available to do that. But I mean, about how long are we talking about to turn around a business valuation?
Yeah, no, you're absolutely right. I mean, I think if the information is readily available and we can get it on day one and there's not a lot of questions about cleanup and everything, typically the turnaround time is about 45 days. And that is also inclusive of some inquiries with management as well as a pretty in-depth management interview that takes place at about the halfway mark. And so yeah, I think it's important to understand kind of our process. Really, it starts with an information gathering phase. First, with financial information, as well as other qualitative information about the business, its top customers, its top suppliers, all of its corporate information, buy sell agreements if they exist, operating agreements, shareholder agreements, everything. We ask for a lot of information up front. So, again, assuming that that all is received quickly, we jump right into what's called our financial analysis. And so we go through a trending process where we look through the last 5 years, typically the last 5 years of balance sheets, income statements, cash flow statements. And we go through that for the purpose of identifying trends, any observable trends in revenue, in certain expense items. And we develop questions about that. We're going to inquire about why insurance is higher in one year than it is another, or why officer compensation was 2 million this year and it was only 500,000 this year. And so those are the questions we ask because we have to get the benefit stream or the cash flows at a normal level. A buyer or anybody that's interested in the business, they're not going to buy it based on what happened in the past. They're going to buy it based on what they think they can generate in the future. To be able to approximate what that future performance may look like, we look to the past and we look to a normal level of performance in the past to determine what the future may look like with some level of reasonable certainty. And so we again, we go through this information gathering process that kind of culminates in what I mentioned is that management interview. We're going to schedule maybe a 3 or 4 hour call or a site visit with our client. And we're going to go through all these questions about the financial statements and about the projections and the expectations for the future and go through the numbers. We're also going to go through a rather in depth qualitative analysis of the company. That's inclusive of the company's history and background, who its customers are, what products and services it sells, how it operates, its facilities, what condition they're in, who the workforce makes up, the employee base, the management team, how the company is governed, the board of directors, everything. And so and the reason we do that, and it's funny because it kind of describes the valuation formula in that interview. The first half is talking about the numbers and the benefit stream. And that's really the first input to the valuation formula, which is the numerator, the future cash flows. We take that numerator, the cash flows, and we divide it by the risk rate expected to generate those future cash flows. And so, in order to determine a reasonable risk rate for the subject company, we have to understand how the company operates and
Right.
every potential risk that could impact it. So again, think about things like customer concentration. If 50% of your revenues are coming from one customer, that's a risk. If you have a very strong management team, you have a CEO, a CFO, COO, a general manager, a whole suite of people to run the company, and a contingency plan if somebody was to leave abruptly, that's a mitigating factor. So that's something that we're going to reduce the risk because you have a strong management team. So all these things, and again, I'm giving a very brief overview of the considerations, but all of these go into determining these two key inputs: the cash flows that are expected to be generated in the future and the risk associated with generating them. And ultimately, that's the valuation formula.
And I think what you're demonstrating here is that it's a very complex calculation that takes a
Yes.
lot of, yeah, a lot of work and assumptions into that as well. And so, circling back to our manufacturing and
Sure.
distribution, potentially that target audience, could you just give us a brief overview of when you see business valuations most applicable or needed specifically in that sector?
Yeah, absolutely. I mean, I think it goes back to some of the stuff that we've already touched on. A lot of the manufacturing and distribution chains are experiencing things that are consistent in many industries. We have aging owners, aging management teams that are looking for the next steps. And we look at what the opportunities are for them. And we talk about a sale to an external party, maybe a sale to the management team. Maybe it's a transition to the next generation of ownership, the kids, the grandkids, whatever. And so we look at that's probably the primary purpose that we're doing valuations for manufacturing and distribution right now, is really helping business owners figure out what the transition plan is. Sometimes we'll come in and we'll do a limited scope engagement to help them just get an idea of what they're worth. Then they can take that number and start to develop what their succession plan may be. Should they be going to market? Should they consider what's called an ESOP? It's an employee stock ownership plan that owns the company and the stock and allocates shares of the stock to the employees of the business. That's a transition strategy when maybe no other strategies exist. Should you be gifting it to your kids? And so a lot of times we come in on the front end when really they don't know what's going to happen. Then we also come in on the back end once they've kind of made an idea, a strategy of how they're going to transition the business. Oftentimes that requires evaluation and sometimes other procedures as well. We do a lot of financial due diligence analysis as well when a company is looking to sell, to get them ready to sell, other types of analysis that can be done to make them presentable to potential buyers.
If you're a business owner that's looking to transition your company and maybe you want to hand that down to the next generation, maybe you want to sell, maybe you want to give that to your management team or key employees of your company or all the employees of your
Right.
company, that step one business valuation is key.
Yeah, because to be completely blunt, you really can't move forward with any of those plans if you don't at least have an idea of what the business is worth. I mean,
Yeah.
how can you go to market and expect to be able to assess offers that you're getting if you don't know what you're worth? Yeah, it's funny. I got a client that called me just last week and he had no plans of selling whatsoever. And he's not much older than we are. And he's not thinking about retirement, but he got an offer and he's like, this has got to be worth way more than I am. So now I have to consider it. And he's like, I
Yeah.
wasn't planning on selling it, but I need you to at least tell me if this is twice as much as what I'm worth. And should I take it? Is it a once in a lifetime opportunity? And so we get called in for things like that too. I mean, again, the reasons that we do valuations are so broad, I couldn't even list them all for you.
Yeah, no, and I think, in closing of this podcast, I think it's important just to know proactive communication, having that conversation with your tax professional or your business valuation professional in your
Sure.
case. I mean, you never know where that conversation may lead, but proactive communication to understand what's required from management, what they need to be putting together, what they need to be thinking about. I think it's all very important.
No, I completely agree. I think from an education standpoint, a lot of business owners aren't even aware that valuation services are out there or that Brown Edwards offers them. I mean, we have some clients that we do valuations on a periodic basis, just like an audit or a tax return.
Mhm.
We may not do it every year, but we may do it every other year or every 3 years, just so that an owner knows what that fluctuation in stock price is. So that if they did have either a triggering event or some transition activity that they were considering, all they have to do is pull up the last valuation and say, well, it's probably around this much. It's only a
Right.
year old. And if it needs updated, it's much easier for us to jump in and do that than it is starting from scratch when maybe you're rushing to come to get to a number.
Absolutely. Well, Vince, we really appreciate you sharing your expert knowledge on this topic today. It's very important. It's something that we deal with on a, pretty
Sure.
routine basis. So we appreciate you kind of giving us a high level overview and for being a guest on our podcast today.
Absolutely. No, I'm very passionate about it. I enjoy getting the opportunity to help business owners transition their ownership to the next generation, the next ownership team, whatever. So it's what I enjoy doing. And like Megan said, we're certainly here to help you. So please feel free to call, email, anything, and we would be more than happy to jump in and talk through whatever you're dealing with.
Absolutely. Thanks, Vince. Appreciate you.
Of course.